In the fast-changing world of financial technology, a new breed of companies has emerged to challenge traditional banks and reshape how we spend money. And in the Middle East, one name now stands out above all the rest: Tabby. Valued at an astonishing $3.3 billion, Tabby has become the region's first fintech unicorn, a milestone that signals more than just a corporate success story. It represents a shift in how consumers shop, how merchants operate, and how financial services adapt to cultural and regional realities. But how exactly did Tabby, a startup that only launched in 2019, grow into one of the most valuable fintech companies in the Middle East? And what lessons does its journey hold for the global fintech industry? Tabby was founded in Dubai in 2019 by Hossam Arab, an entrepreneur with deep roots in the e-commerce space. Arab had previously co-founded Namshi, a fashion e-commerce platform, later acquired by Emaar Malls and then Noon. That experience exposed him to one of the region's biggest bottlenecks: payments. In much of the Middle East, cash on delivery was still the dominant payment method. Shoppers were hesitant to use credit cards online, often due to trust issues, low penetration, or cultural preferences. This reliance on COD created inefficiencies for merchants who faced higher return rates, delivery delays, and added costs. Arab saw an opportunity to solve this problem by offering an alternative that could bridge the gap between consumers' desire for flexibility and merchants' need for reliable payments. That is how Tabby was born. At its core, Tabby is a buy now, pay later platform. Instead of paying for a product upfront, consumers can split the cost into interest-free installments. For shoppers, this offers flexibility. For merchants, it increases conversion rates, average order values, and customer loyalty. But Tabby's success wasn't just about importing a global BNPL trend into the Middle East. It was about localizing it. In a region where many consumers don't own credit cards, Tabby allowed them to shop using debit cards or linked accounts. In a culture where debt is often viewed with caution, Tabby emphasized zero interest and zero hidden fees. And in markets where COD was deeply entrenched, Tabby positioned itself as a modern alternative, promising convenience and transparency. Its growth accelerated quickly thanks to partnerships with major retailers. Brands like IKEA, H&M, Adidas, and Shein joined Tabby's network alongside hundreds of local merchants. For these retailers, the pitch was compelling. With Tabby, customers were more likely to complete purchases instead of abandoning carts. Average order values rose, and shoppers returned more often. This win-win model fueled rapid adoption. Within a few years, Tabby was processing millions of transactions across the UAE, Saudi Arabia, and beyond. By 2021, it was already recognized as one of the fastest-growing startups in the region. Like many fintechs, Tabby's expansion was powered by significant venture capital funding. In 2020, it raised $7 million in seed funding. By 2021, it secured $50 million in Series B financing, led by Global Founders Capital and STV. In 2022, another $150 million came in, pushing its valuation close to $1 billion. And by late 2023, Tabby hit $3.3 billion in valuation after raising $200 million in Series D funding led by Wellington Management, with participation from Mubadala Investment Capital, PayPal Ventures, and others. The speed of this funding reflected investors' confidence not just in Tabby, but in the broader Middle Eastern fintech market. Globally, buy now, pay later is a crowded space with giants like Klarna, Afterpay, and Affirm. But Tabby carved out a unique edge by understanding regional dynamics. Klarna and Afterpay rely heavily on credit card integration, but Tabby worked around lower credit card penetration. Western markets often face pushback from regulators over debt risks, while Tabby's focus on short-term, interest-free payments fit cultural norms more naturally. And while competition existed in the region, especially from Saudi Arabia's Tamara, Tabby's aggressive funding rounds, merchant network, and rapid user acquisition helped it secure the title of the first unicorn. While Tabby made its name in BNPL, it has expanded into becoming a broader financial platform. In 2022, it launched a shopping app that aggregates deals from retailers, turning Tabby into a discovery platform as well as a payment solution. It introduced a digital wallet so users could manage spending and track installments easily. It also experimented with loyalty programs and cashback features, deepening engagement beyond the transaction. This mirrors a global trend where BNPL companies evolve into super apps for commerce and finance. To appreciate Tabby's rise, you have to look at the cultural and economic context. The Middle East, especially the Gulf, has high smartphone penetration and a young, tech-savvy population. E-commerce adoption skyrocketed during and after the pandemic. A large portion of the population is unbanked or underbanked, making alternative financial services highly attractive. Governments in the UAE and Saudi Arabia have supported fintech innovation with sandboxes and licensing frameworks. Tabby's model fit perfectly into these trends, bridging financial gaps while riding the wave of digital commerce. Still, challenges remain. Consumer debt risk is one. BNPL can encourage overspending. Regulation is another. As the model grows, governments may introduce stricter rules. Competition remains fierce, with rivals like Tamara growing fast. And sustainability is a concern, since rising interest rates globally make financing BNPL programs more costly. Tabby's future depends on how it navigates these hurdles while sustaining growth. But Tabby's rise isn't just a Middle Eastern story, it has global implications. For years, fintech unicorns mostly came from the US, Europe, or China. Tabby proves that emerging markets can produce billion-dollar companies tailored to local realities. It also raises the question of BNPL's future. Is it a temporary trend or a permanent feature of commerce? Tabby seems to be betting on the latter, building tools that go beyond payments. From tackling cash on delivery to becoming a multi-billion-dollar company, Tabby's story is one of timing, vision, and adaptation. It shows how fintech can thrive when it understands culture, solves real problems, and scales quickly with the right support. For consumers, Tabby means freedom and flexibility. For merchants, it's a growth tool. And for the Middle East, it cements the region's place on the global fintech map. As the company continues to expand and evolve, one thing is certain: the Tabby story is just beginning. But what truly sets Tabby apart is how it has managed to capture the trust of both consumers and merchants in a market where financial trust is fragile. Cash on delivery didn't dominate the Middle East for no reason. It was born out of years of hesitation, skepticism, and experiences where customers felt unsafe putting their card details online. To build something that could replace COD required more than a clever business model. It required a cultural breakthrough. Tabby understood this deeply. Instead of forcing customers to adapt to it, Tabby adapted to the customers. Its branding always leaned on transparency. Its messaging focused on no interest, no hidden fees, and its app design emphasized simplicity rather than financial jargon. In short, it wasn't just about enabling payments. It was about making people feel safe enough to change long-standing behavior. This cultural trust building is part of why Tabby grew so fast in Saudi Arabia. The kingdom is one of the largest e-commerce markets in the region, yet one where COD accounted for more than half of transactions even as late as 2018. By giving Saudi consumers the option to buy instantly while paying later, without the risk of hidden charges, Tabby became a bridge between traditional behaviors and digital commerce. And as Saudi Arabia's Vision 2030 drives massive digital transformation, Tabby positioned itself not just as a convenient payment option, but as part of the broader story of modernization. The mechanics of BNPL also create a powerful feedback loop for growth. Every time a consumer uses Tabby successfully, their trust in the system deepens. Every time a retailer sees higher conversions through Tabby, they invest further into the partnership. And every time a new big-name merchant signs on, it validates Tabby's brand for other customers. This flywheel is what powered its rapid adoption across thousands of retailers in the Gulf. From fashion to electronics, from luxury to essentials, Tabby became more than a payment method. It became a symbol of modern shopping. Yet the company is not blind to its vulnerabilities. Globally, BNPL has faced criticism for encouraging overspending, especially among younger consumers. Regulators in the UK, Europe, and the US are increasingly scrutinizing companies like Klarna and Affirm. Tabby, watching this closely, has tried to shape a different narrative. Instead of pushing heavy debt, its installment cycles are shorter, often capped at 4 payments. Instead of charging consumers interest, it charges merchants fees. Instead of positioning itself as credit, it positions itself as a budgeting tool. Whether regulators in the Middle East will accept this framing, long-term is still unknown. But for now, it has helped Tabby grow without the same level of backlash seen elsewhere. Another key part of Tabby's journey is how it leveraged funding strategically. In the startup world, capital can be both a blessing and a curse. It allows for rapid scaling, but it can also encourage reckless spending. Tabby, however, deployed its funding to expand geographically, invest in technology infrastructure, and build partnerships with marquee retailers. Its investors were not just financial backers, but strategic allies. Wellington Management gave institutional credibility. This blend of regional and global investors signaled to the market that Tabby was not just a local experiment, but a serious contender in the global fintech arena. What's particularly fascinating is how Tabby has started reshaping consumer psychology in the Middle East. Traditionally, financial institutions in the region have been slow-moving, with banks dominating lending and credit. Access to credit cards or loans often required significant paperwork, high income, or lengthy approvals. Tabby flipped this model by giving consumers instant access to flexible purchasing power, all through a few clicks. For younger consumers especially, this was revolutionary. It gave them a sense of financial independence without the weight of traditional credit systems. And as e-commerce grows in the region, this shift in consumer psychology will ripple out into other parts of the financial ecosystem. Tabby also represents the growing trend of financial super apps in emerging markets. What started as a BNPL tool has gradually expanded into a broader lifestyle platform. The Tabby app now not only processes payments but also curates shopping deals, provides financial insights, and builds loyalty ecosystems. This strategy mirrors that of super apps in Asia, like Grab or WeChat, which began in one sector and grew into dominant consumer ecosystems. If Tabby succeeds in fully realizing this vision, it won't just be a BNPL company. It could become the digital financial hub of the Middle East. Looking ahead, international expansion is likely on Tabby's horizon. While its current focus is on the Gulf and nearby markets, the appetite for BNPL stretches far beyond. North Africa, with its massive youth population and rising digital adoption, could be fertile ground. So could South Asia, where millions are still unbanked but highly connected via smartphones. The question is not whether Tabby can expand, but how quickly it can do so while maintaining the same cultural adaptability that fueled its early success. There's also the looming competition with Tamara, another Saudi-based BNPL unicorn. The rivalry between Tabby and Tamara mirrors the kind of competitive dynamics seen in Silicon Valley between Uber and Lyft, or in China between Alibaba and JD. Both companies are backed by heavy funding. Both are racing to sign merchants and win customers. And both are trying to become the dominant fintech super app in the Gulf. This competition will likely define the next chapter of BNPL in the Middle East, and it may ultimately be consumers who benefit the most from this rivalry. The macroeconomic environment will also test Tabby's resilience. As global interest rates remain high, the cost of financing installment plans increases. In mature BNPL markets, like the US, some companies have struggled with profitability as a result. Tabby will need to balance growth with sustainability, ensuring that its business model remains robust even in less favorable economic conditions. That may mean diversifying revenue streams, exploring financial partnerships, or leaning further into value-added services for merchants. But beyond the numbers and strategies, Tabby's story is a reminder of how innovation often emerges from solving very specific, very local problems. Western BNPL giants were born in markets where credit cards were already common, but consumers wanted more flexible options. Tabby was born in a market where credit card use was rare and COD was king. By building around those local realities, Tabby didn't just replicate a global trend, it reinvented it for its own region. And that reinvention is what made it the first fintech unicorn in the Middle East. In many ways, Tabby's journey echoes the broader rise of Middle Eastern startups. For years, the region was seen as dependent on oil and slow to innovate. But over the past decade, a wave of new companies has begun changing that perception. Kareem in ride-hailing, Anghami in music streaming, Noon in e-commerce, and now Tabby in fintech. Each of these stories proves that local innovators can build world-class companies that not only serve the region, but also influence global industries. As Tabby continues to grow, its greatest challenge may not be competition or regulation. It may be living up to its own narrative. Being the first unicorn in a space comes with the responsibility of proving that the model works long-term. If Tabby can demonstrate profitability, scale responsibly, and expand thoughtfully, it won't just remain a unicorn. It could become a multi-billion-dollar decacorn. But if it stumbles, it risks fueling skepticism about fintech in the region. The stakes are high, but so is the potential. For now, Tabby stands as a beacon of what's possible when timing, cultural insight, and bold ambition intersect. It is not just reshaping how people pay for goods, it is reshaping how the Middle East sees financial services. It represents a new era where innovation is no longer imported, but homegrown, where regional challenges are turned into billion-dollar opportunities. And as the story of Tabby continues to unfold, one thing is certain: it has already left a lasting mark on the financial and entrepreneurial landscape of the Middle East. From a startup solving the pain of cash on delivery to a $3.3 billion unicorn redefining digital payments, Tabby's rise is nothing short of extraordinary. Its next chapter will determine whether it becomes a regional powerhouse or a global leader. Either way, its impact has already inspired countless entrepreneurs and shown that the future of fintech is being written not just in Silicon Valley, London, or Shanghai, but also in Dubai and Riyadh. If you found this story of Tabby's rise insightful, make sure to hit the like button, share it with others who love exploring stories of innovation, and subscribe for more deep dives into the companies shaping our future. Your support helps us bring you more stories of startups, breakthroughs, and the bold ideas that are changing the world.